Well, good afternoon, everyone, and welcome to today's market update. I'm Greg Patterson, and I am joined with my teammates J.A. Kennedy and Tara Gould, and we are with Atlantic Wealth Management. This is our July mid-year market and economic update, and we are pleased to bring it to you today. We certainly hope all of you and your families have had a great summer so far, and we hope that you're enjoying all that the Crystal Coast has to offer. Certainly been a hot one, and we are thankful for the rain, but we are excited to be here with you today, and we've allocated some time today to talk through all that's going on, and certainly the weekend was no exception to headlines. So we're going to dive right into it. I do ask if you have questions or feedback. We love to get that back from you guys, so if you would kindly let us know. You can do that a variety of ways. You can certainly email Mackenzie Sherrard, and you can do that at mackenzie@myatlanticwealth.com. You can call us at our number here, 252-515-7800. And of course, you can send any of the three of us an email as well. We love to hear from you and look forward to any questions or feedback that you have. Lastly, we are doing these every quarter. Our next one is scheduled for October 21st. That's a Monday afternoon. Go ahead and mark it on your calendars, and we'll be getting an invite out as it gets closer to that date. But you might have friends or loved ones that could benefit from this type of format, and we would welcome you to invite them. And we do make these available after compliance approves it. So generally that's a couple of weeks, and we'll load it up to our website. And we encourage you to use that as a tool to go back to. Also, you can invite, like I said, friends or loved ones to watch. So with that, we have a lot that gets covered. So let's go ahead and dive right in today. We got the agenda posted up for you. We want to take a look at current market returns. Things have been really good, and Tara's going to share that with us. We're going to look at some economic data points. We always try to do that in these sessions. We're going to revisit the outlook of 2024 and go back to what we had shared with you guys earlier in the year. Of course, we would be remiss if we didn't talk about the election and the impact that we think that has on the market, both from a rear view mirror point of view, but also a forward-thinking point of view. We're going to try to read the tea leaves, if you will. Also, we're going to talk through artificial intelligence, the buzzword there, AI. This has made headlines for quite some time now, and we're going to go through just a couple of quick points on that. And then we're going to wrap it up with our conclusions and hopefully give you guys some good stuff to carry on today and the week. So with that, let's move right on in. Tara, you want to give us a quick update on the markets?
Of course. So what we're going to take a look at is three different indexes. We'll look at year to date and then 1 year overall. Remembering that indexes are not managed. You don't directly invest into an index. You invest in a fund that mirrors that index. But most popular, the index that most people recognize, especially when we talk about the overall market, we're referring to the S&P 500. It is recognized as likely the best gauge of the overall United States or domestic market. On average, about 500 of the leading companies in the United States. And so what we're looking at, the chart here, is year to date. So January, we kicked off the index slightly over 4,700. So you can see on the left-hand side of the screen where we started in January. And this is as of market close on Friday. The index was trading at over 5,500. It's actually slightly up as of market close today. But we're looking at year-to-date an increase of about 16%. And then next, we take a look at the 1 year. This is also very exciting to see. In July of last year, the index was trading just slightly above 4,500. And like I mentioned before, we're over 5,500 now. So we're talking 1,000-point gain over this 1 year period. When we put that into a percentage perspective, that's an increase of over 20%. Next, we're going to take a look at Russell 2000. So the Russell 2000 So we looked at large companies or large cap with the S&P 500. Now let's look at smaller companies. And this is what the Russell 2000 encompasses. So the index year to date is actually up over 180 points. So you can see where we started the year was slightly up, upwards of 2,000. And now we're currently trading at over 2180. So that's an 8.5% increase year to date. And then taking a step back, we're going to look at that 1 year return and looking at the movement of the market July of 2023. So again, on that left-hand side, you can see that we started slightly under 2,000, and today, or as of Friday, today we're actually slightly up a little bit at 2180, and that's an increase of over 11%. And the last one we're going to review here is NASDAQ. So when you think of NASDAQ, we think of tech companies, heavily weighted. More than half of companies in the NASDAQ index are associated with techs. So we look at the beginning of the year. So let's take a look at January. January 2nd was the first trading day of the year. The index was right up under 15,000. And you can see where we're currently at now, 17,700. So that's an increase of 20% year to date. So if we take a look at broader, Jay, you're on point today. We take a look at the broader time frame, 1 year. Going back to July of 2023, the index was slightly above 14,000. We fast forward today, that's an increase of over 3,000 points. Put that into a percentage, an increase of over 26%.
Great. Those are good returns. Thank you, Tara.
Yeah.
Good afternoon, everybody. We just want to take a minute to address a couple things that have been in the news headlines if we look over the last 6 months or even maybe more in some of these cases. But specifically with regards to the Magnificent Seven, which you may have heard reported on, this refers to 7 of the top companies, primarily tech companies, that have been big drivers of the market. And we just wanted to kind of highlight that to bring some clarity around that to you guys this afternoon. These companies are NVIDIA, Amazon, Facebook, Google, Microsoft, Apple, Tesla. That's the Mag 7. And if we look at just the first half of the year, the chart there at the top left, the overall return of the S&P 500 was 15.3%. 6.18% of that were companies that were not part of the Mag 7. The remainder of that, 9.12, were Mag 7 companies. But if we just look at overall market return, so big drivers of the market the first half of the year, and even when we look into the last quarter of last year. Now, if we go back further, those were also areas hardest hit when we saw interest rates rise in the latter part of 22. But have definitely seen recovery plus some there. And if we look at from an earnings standpoint, it's even more impactful, where we see the Mag 7, the first half of the year, 86.7% of the earnings growth came from those 7 companies, with only 13 from the remainder. We would expect these companies to continue to be drivers going forward of growth. And specifically, we're going to talk more about AI, but they are big in the AI space, most of these companies. But we would also expect a more broadening out over time of those returns and earnings growth, as you know, the wealth is shared, so to speak, over the broader market. The other thing we wanted to talk about briefly was the Consumer Price Index. And this, when we mention the CPI or Consumer Price Index, it's really, we're talking about inflation. This is something we've covered on our previous webinars, but I wanted to highlight this once again because it is a big area of focus for the Fed and the overall market, and a big driver of what the economy looks like going forward. We had positive news with this last report for the CPI, where it got back down to 3%. If you look at the chart, we did hit 3% back in June of last year. And at that time, we thought, hey, we're on our way to 2%. here we are a year later. We finally made it back to 3% after some ups and downs, as you can see. So that is positive and encouraging. And as we go forward, this just is a bar graph of those monthly, month-to-month returns of the inflation numbers. So you can see we've had a couple months trend of very low month-to-month inflation. The expectations are that we'll continue to slowly trend down with that overall CPI number. And we'll talk a little bit more about that in just a couple minutes.
You know, JA clients from time to time will share that they don't feel like prices are coming down. And so I think it's important to note these charts are a reflection of what that month over month or year over year price. And it's not indicative of prices going backwards, but just the slowing of the increase, right?
That's a great point. Yeah. What we want to see is more of the 0.1 months versus the 0.5 months.
Yeah.
A slower increase. So great point, Greg.
So LEI, in past webinars, we've talked about this before. We wanted to bring this index back. So as you can see at the bottom here, the LEI is what we'll refer to, but it's the leading economic index. It's produced by the Conference Board. And the purpose of it is to provide an early indication of significant turning points in the business cycle and where the economy is expected to go looking forward. So a little bit of background on the LEI. What does this index include? There's actually 10 components in the LEI. I won't name all of them, but just a few. JA is going to hit on a lot of them in just a moment. But it looks at manufacturing, unemployment claims. It looks at orders for consumer goods and materials. It looks at the S&P 500, which we talked about earlier. It looks at credit. And it also looks at consumer expectations. So what you can see here is in June, I'll highlight the last release of the LEI. So in June, the LEI was slightly down, but overall the 6-month growth rate has trended less negative. And what that means is they have now switched off the recession signal. So you can see that red line that goes across correlates to the recession signal, and where we are as of end of month June is we've slightly ticked above that. And I just want to read a quote really quickly from the Conference Board in regards to the release of June's data. And so their notes are that June's data suggests economic activity is likely to continue to lose momentum in the months ahead. What they're currently forecasting is a cooling of consumer spending, which will push GDP growth down to around 1% is their prediction in Q3 of this year. And so not necessarily saying going backwards, but what we're seeing is a overall slowing of economic activity.
We'll talk a little bit more about that in just a minute. Thank you, Tara. On these webinar updates, we like to just kind of go through a highlight of the economic data that we are focused on a regular basis. We've already talked about inflation and the CPI. The PPI is similar to the CPI, but it measures producer prices as opposed to consumer prices. And so that is running, the PPI is running on a year-over-year basis at 2.6% was the last reading. That's a little less than the CPI. We would say that that's a good trend for it to be less than the CPI. If the producer prices started increasing more than the CPI, then we would expect that to flow through to the CPI over time as producers pass that on to consumers. We have seen a little bit of an uptick in the producer price index over the last couple of months. So that's something we'll continue to pay attention to. From an employment standpoint, we have seen unemployment creep up some over the last few months, and we hit the 4% level month before last, and then the reading for June came in at 4.1%. So we have slowly increased that if we look over the last six or 7 months. The initial jobless claims number that we pay attention to as well has crept up a little bit of late, but we're still under 250,000 a week. So not alarming levels yet, but we're continuing to look at the monthly unemployment and the initial jobless claims. From a housing market standpoint, we've talked about this previously. We have seen some cooling off. We had seen where new home sales were really positive. They have decreased or some from the rate at which we were seeing. Existing home sales continue to be down as it's hard for folks to get out of their existing homes with their low interest rates on mortgages if they bought, you know, prior to 2 years ago. And we also look at building permits, and those we're increasing from a new permitting standpoint, but just at slower pace than we had seen. As we go forward, you know, if we start to see some rate increases, that may be something that spurs on getting back to levels we were seeing from a housing market standpoint. Retail sales, this is just measuring consumer spending, and they have been positive, but not stellar. If we look back from a year ago, retail sales are up 2.3%. So I guess we could, if we look at inflation running 3%, retail sales at 2.3%. So if you just compare those two things, we wouldn't have kept pace from a spending standpoint with the rate of inflation. Buying less, but still positive. And then industrial production, this is really an area where we have seen over the last few months, this has been a positive area for the economy. For 2 months in a row, we've seen all areas of industrial production increase. And we've seen the fastest pace of increase since 2021, when we had all of the economic stimulus that was driving things. People were stuck at home and buying things, and we were producing to accommodate. And then that brings us to the gross domestic product, GDP, which is a measurement of overall growth. We expect this week to get the first estimate of second quarter GDP. And there's a range of expectations around that, anywhere from 1.9% annualized growth to 2.7%. So the Atlanta Fed always tends to be on the high end. They're at 2.7%. But the rest of the forecasts really are more around 2%, right around that 2% mark. So we'll see that later this week. In comparison, the last revision to the first quarter growth, we started out, first estimate was at 1.6%. Then it was reduced, the second estimate 30 days later, to 1.3. And then at the end of June, the final estimate was 1.4. So even on the low end of those expectations for second quarter, they would be higher than we saw in the first quarter. And then the Fed, that's been a big area of focus for quite a while now, with the interest rate environment, and when is the Fed gonna start to reduce rates? And with that CPI number coming in at 3%, the thoughts are now, the consensus seems to be that we're probably going to see a rate decrease starting in December at a quarter point, or excuse me, September at a quarter point. And then we'll wait and see, you know, what happens. I think it's going to depend on the economic data, even between now and then, to solidify that September action, but then also from then to the rest of the year, to see how inflation and all this other data continues to track.
Now, the Fed's supposed to be non-political, nonpartisan.
It's supposed to be.
Cut rates before the election.
And that is before the election, isn't it? September?
Yes.
I don't know. We'll have to investigate the conspiracy theories around that. But no, I think that the response and the expectations around that really are primarily driven by inflation getting to 3%. They've had a target of 2%, but
Right.
the trend, I think there's the market's hopeful that we're going to continue the trend of decreasing inflation.
They're serious about getting to the 2% target.
Not before they decrease rates. We won't get there in a couple months.
Yeah.
Yeah. Great. Thanks for your patience in going through all of that, all those details. Now we get to the fun stuff, the news headlines. And just looking back, this is from about a month ago. This Bank of America poll shows that cash is ready to fuel stock market rally. That is one thing that we would say is a tailwind. If we take a snapshot of where things are today, there's still a lot of money in money market accounts that would be ready to help fuel continued growth and positive numbers in the stock market. This is a piggyback on that first headline there, where a member of the private bank says that the bull may turn into a buffalo and start to roam a little more, but I think the uptrend is intact. So if we look back to the beginning of this month, we see this headline: stocks could fall 30% as U.S. heads for a deep recession, analyst warns. This was July 1st. And on the same day, this is JP Morgan, stock market has further upside, JP Morgan's Jackson says. So he says there's a fundamental case to support a continued rally in the U.S. market. And then if we go back a year ago, this is from the end of June 2023, why a U.S. recession might happen in time for a 2024 election. There's not a lot of people that are calling a recession before the election. If we take the poll today, but this is where we sat a year ago. If we look back further, there was a time at which there was a consensus that we were going to go into recession by this time, and we have not. So because of interest rate environments, the rapid increase in rates and the impact on that to slow the economy, we have kind of seen a resilient, economy, much more resilient than a lot of folks thought. If we go back even just 5 months ago, the U.S. now has an 85% chance of recession in 2024, the highest probability since the great financial crisis, economist David Rosenberg says. So there's still time left in this year, but based on where things are right now, and even factoring in that we may start to see some rate decreases from the Fed's standpoint, is not leading us to call the next recession in the next few months. Let's put it that way.
Yeah, it's interesting though, you can see the disparity in the opinions on that
That's
from
right.
top financial firms
That's true.
who you would think would have all the resources to predict the which direction it goes.
And that's a trend we've seen for a while,
Yes.
since COVID really. And I mean, we can speculate about why, but really we've dumped a lot of money into the economy, and we have no previous historical data to say, hey, this is what happens when we do this. So
Right.
We're setting precedent here. So
Well, and it's no surprise prices have risen because of that.
that's right. Yep.
All right, 2024 outlook. So we're calling this basically a revisit. We talked about this in January and then also again in April, and just want to talk through these points when we were preparing for today, and looking at, okay, is our outlook for 2024 still within this range? And the answer is yes. So the first point here, a recession is less likely based on the information that JA discussed. Is it possible? Sure, but it's much less likely than we were thinking, last year and even before then. Inflation is continuing on its downward trajectory. At some points, we do have some upticks, but overall, we are seeing a downward trend in inflation. We believe that Fed cuts will happen at some point this year. Like JA mentioned, potentially the buzz is In September, we would be looking at a first rate cut. It's not set in stone, but that's something that's being looked at very heavily. We do believe that the economy is, I don't want to say holding off the gas pedal. How would you guys say that? We're not full throttle anymore. Our economy is continuing to grow, but we're just slowing down a little bit. And we still believe that to be the case. As always, as an investor, as we are staying cautious and prudent in making investment decisions, not based off of emotion or something that maybe you've heard, but looking at your overall financial plan. And when we're putting plans together, we are expecting these things over time to occur, and we're testing your plan against that.
Well,
Just a
it's
quick-
also important
Yeah.
to make a note that everybody's situation is unique.
Sure.
So while we can look at the economy as a whole, each individual client situation is different than another. When they need cash, what their risk tolerance is, what their goals are, why are they even investing in the first place? Do they need income, or are they trying to grow money for the future? And so, we talk about the economy and what's taking place more to give insight into those types of issues, but everybody is unique in their own financial circumstances. So we pride ourselves on getting to know clients well and walking with them through these time periods, and providing that feedback just as we are today.
Yeah, I was just gonna make one follow-up comment just about the economic slowdown, that the economy will slow down. If we look back, the third quarter of last year, we were 4.9% annualized on the third quarter. The fourth quarter was 3.4%, but we finished the year 2023 at 2.5%. So to think about a 1.4% first quarter and a 2% second quarter, that's not dramatic in terms of slowdown.
Right.
And still positive. So,
well, and it's not even a reason to abandon a well thought out investment plan. And I know sometimes the tendency could be to time it and to try to be on the front side of any type of slowdown. But even in this environment, there are still plenty of good opportunities to invest and grow money. Tara went over just the U.S. stock market and how well it's done year to date. And there's value still to be had. So that's one of the reasons why we exist, is to uncover those and to help folks invest in them.
that's right.
All right, shifting gears a little bit. If you missed one day of the news cycle over the weekend, you missed something pretty big. Surprising, maybe it shouldn't be, but it brings us back to the point that we try to remain politically agnostic, because we believe over the long period of time, and when we say long period of time, we're talking about a market cycle, 7 to 10 years, that we believe that stocks really are also politically agnostic. And on a personal note, I think most of your life is governed by what happens at the town level. So the Morehead City Town Council, for example, or Carteret County commissioners have more impact on your life, if you think about it, than what's happening in Washington, D.C. You don't see that on the evening news. It's not as exciting or glamorous, but that's really the facts. I mean, what are your property taxes going to be? How are your, what's the crime rate? What are the schools like? Who's on the school board? I mean, those are the things that really impact your life. Certainly, it's fun to talk about the presidential election year, so we wanted to share this with you. What you're looking at is the U.S. stock market in 8 decades of election returns, and looking at the year of the presidential election. So that far left-hand column is the year of the election. The next column to your right in is the pre-election, so the months of January through October. And what did the S&P 500 return for that time period? You take one step to the right again, the full year of that election. How did the S&P 500 do? And while every year was not positive, most of them were. About 10.5% almost was the average return. And then the far right column is the year after the election. So what happened the 12 months after the presidential election? And again, there were some negative returns there, but generally speaking, the US stock market was up 9.8% averaged over that time period. Flipping the page and looking at this in a different way, we can look at the probability of the stock market making money in the year of the presidential election. And there have been 23 election years since the S&P 500 began. So 19 of those 23 provided positive performance, and that was in both Democrat and Republican presidential election years where the president was elected. And you can see even when a Democrat was in office and a new Democrat was elected, the total return was 11% for that year. When a Democrat was in office and a Republican was elected, the total return was averaged out to 12.9%. Again, some of these years there were negative returns, but probability or statistically speaking, 83% of the time stocks were positive. And so we're not trying to read the tea leaves, just give you a rear view mirror of what happened, and hopefully to dispel any notion that we're going to fall off the edge of the world here. More than likely, Wall Street will figure this out and stocks will continue to make money, because owning shares of stock or just owning companies in America and international companies, and those companies provide goods and services and make profits, have earnings. So we believe that long term you'll do just fine there. And then a longer term look at that in a mountain chart, you can see the hypothetical growth of $1,000 invested in the US stock market ended up almost 9.5 million. I know we don't have that long of a time period, but the point of the matter is, over time, stocks tend to outperform bonds, which tend to outperform cash. We're not going to try to catch the falling knife. If there was one, we're going to let it hit the kitchen floor and we'll work from that point. And as we've shared with many of you over our relationship, some of you have been many years, even decades, we do expect this rotation in capital markets where there is a recession and where your accounts do have negative results. Nobody wants to talk about that, but we'll go ahead and tell you up front, we will invest money for you. Most of the time you'll make money. There will be some times where you'll lose it. That's not the reason to abandon a well thought out plan. Quite the opposite. It's probably a great time to invest and to see your dollars grow in a way that is meaningful to you.
Buy low, that's a good principle, right?
Yeah, exactly. We always have the pundits out there that tend to try to call it, and it makes it somewhat exciting. But if you really step back and think about it, when Tara, J.A., or myself sit down with you and talk about these things, we are thinking about your financial life in three buckets, if you will. What's short term? What's coming up in the next year or two that you need money? What's something that's coming out in the next 5 to 6 years or so? And then what's the longer term picture? We never would want to take long-term money and put it in a short-term account, nor would we want to take short-term money and put it in a long-term account. Just doesn't make sense for us. And so when we think about it that way, you can bridge the gap of what the stock market is doing day to day, or who the president is going to be, or what interest rates are, or even what inflation is. But know that if you're going to need to grow money over time, the only asset category that does well, there's two: real estate and stocks. And you'll be well suited and glad that you did. I think our oldest clients over time have shown us that. We've seen their portfolio and just are blown away. So it makes us a believer. And of course, we've done this for many years as well, helping clients through good markets and bad. Usually if you sell out, you're going to sell out at the worst time. It's nice to have the market up like it is today so that clients can, have a little bit of that perspective. And if you watch the news a lot, it's probably going to make you sick to your stomach. We just say, take the dog out for a walk, go do the things you love to do, hug your grandkids, be thankful for the place that we live. Carteret County is incredible. If you live somewhere else in the United States, our guess is that it's probably wonderful there too. So yeah, we try to have a less emotional way to look at this. And hopefully that's why, one of the reasons why you've hired us on. And if you're not a client, you're watching this, we would welcome the opportunity to talk with you too. And we're still the ones you would talk to. I think the next slide is going to talk a little bit about artificial intelligence. So this has been the buzzword over quite some time. And I think there's some things that you'll never be able to hire out to a robot. And if you've done any construction work, you know that a robot's not going to put a roof on your house. Consequently, I think there's been a lot of industries that's not going to be the case. It's going to hopefully enhance your life. And so we know that 2023 was the year for AI excitement, this artificial intelligence buzz. We think, though, that this year is the year for deployment. And Jay has talked about the Magnificent Seven. The reason that those companies have done so well is because of their earnings. And there's been a lot of demand for those companies, and thus their stock price has gone up as a result. But not just those. In the first quarter's earning calls, approximately 45% of those S&P companies mentioned artificial intelligence, which is a fresh high by our measures of companies mentioning it and putting capital expenditures into that. It's been a 7% year-over-year pace in quarter one, up from 4% last year. So, we do see this increase in capital expenditures by the S&P 500 companies, and we expect them to spend $200 billion this year on CapEx, which would represent a 37% year-over-year growth. And of course, over the last decade, that's 10 times of growth in this one particular technology. We can see that show up in what I think the buzzword is called hyperscalers, or they're known as hyperscale cloud providers. And this term refers to the largest tech companies that operate these massive data centers, and they provide scalable cloud computing services. So when we think about what technology is required to run AI, the five major companies are Amazon, Microsoft, Meta, Oracle, and Alphabet. As a diversified investment manager to help you, we do invest in that technology. And we can see in the chart here that the next 6 months looks even better from a capital investment or expenditure standpoint than where we are today. So we just bring that to the table. This is work that we're doing on your behalf behind the scenes, but we also think it's important to talk about trends and things that are happening. Doesn't mean that, the robot will be cooking your meals for you. Probably not anytime soon, but certainly we're closer in that direction than we have been.
That's good, Greg. Thanks.
Jay, your family probably could benefit from a robot cooking some meals for all of you, couldn't it?
That would be great.
So,
That would be great.
yeah.
I'll do
You'll
that.
have to settle for the Wendy's drive-through in the meantime.
That's right. We'll be the beta test. We'll volunteer
Yeah.
for the beta
Okay.
testing. No, Greg mentioned not getting sucked in too much to the news and just cutting it off and getting outside as an alternative. We would also say the place for wisdom and truth and encouragement is really God's word. And so we always highlight a passage from it as we close out these webinars. And today, these couple verses come from Philippians chapter 4, verses 8 and 9. This is Paul writing. from prison. And he says, finally, brothers, whatever is true, whatever is honorable, whatever is just, whatever is pure, whatever is lovely, whatever is commendable, if there is any excellence, if there's anything worthy of praise, think about these things. What you have learned and received and heard and seen in me, practice these things, and the God of peace will be with you. And so, first of all, we acknowledge that our God of peace, that he does bring peace, and that he's the source of peace. And then just kind of going backwards there, that we should practice what we read about in his word, these things that we are instructed to do and the encouragement that we get from it. And then just thinking about the news and just so many different things to focus on, and spend our time thinking on and even worrying about. We really should be thinking on these things that are highlighted in verse 8 here. Whatever is true, whatever is honorable, whatever is just, pure, lovely, commendable, if there's any excellence, if there's anything worthy of praise, think about these things. So just wanted to highlight that, encourage you guys in that. And with that, want to thank you for attending the webinar today with us. We are here to serve folks and to be a resource. So if you have questions about anything that we've mentioned, or if you have others that you think would benefit from a conversation with us, be it friends, family, coworkers, neighbors, then we are here just to meet with them or have a conversation with them. We enjoy helping and serving folks, and so we welcome the opportunity to do that more. Lastly, we have our client appreciation event, our 10-year celebration that is coming up August 22nd at the Civic Center here in Morehead City. So we hope that all of you will be able to make it. If you haven't RSVP'd, please let us know. We're finalizing that RSVP list in the next few days. So it's at 5:30. 10 years, 10-year celebration. It's been fast, it's been good, and we're excited about the next 10 years. So thank you for making it possible.
The best is yet to come.
That's right. Take care and God bless.
See you guys.